Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat on this Memorial Day, May 27th of 2024. Well, I hope all of you are enjoying a wonderful long weekend and you all take time to remember why we do have a Memorial Day and that freedom is not free and grave and great sacrifices have been made throughout time to protect our freedom. So please remember that as you go about your business today. But welcome, glad to have you with us. Get started in the chart pack, maybe slightly lighter than the usual pack here today, but just want to talk a little bit about earnings, economics, the markets a little bit, and just kind of give a sense of where we are heading into June. Here we have the S&P 500 earnings per share from a year ago as we look into these lighter shaded bars here on the right of the screen. This represents estimates moving forward. And so you can see that, as we look out to the end of the year, a lot of the pessimism that we had, at various points over the last couple of years with regard to the forward outlook have really kind of dissipated a little bit. We'll see a little bit later that the number of mentions of inflation in earnings reports have gone down actually fairly dramatically lately. And we do see some of these pressures ease somewhat. Now, we're not taking our foot off the accelerator necessarily, and obviously the Fed is kind of is stuck in that low gear, not wanting to reduce rates necessarily right now to restoke inflation, but not very enthusiastic about lowering rates given the strength in the economy as we see it. And here's a manifestation of that. We see the estimates as we head towards the end of the year actually strengthening, not weakening. We'll look at some historical data from JP Morgan. Always good to refresh and kind of remind ourselves the power of long-term investing. And this represents a chart that shows you over various time frames, what the probability of loss is and what the average annual return is for various asset classes. And in the green, we've got stocks. In the blue, we've got bonds. And in that gray area, dark gray, we have what is traditionally known as a 60% stock, 40% bond portfolio. You can see average annual total return in a 60-40 portfolio is about 9%. And you can see over 1 year that can be very volatile. So the importance of having long-term horizons is very imperative. And as you can see, if you have a 10-year rolling, on a 10-year rolling basis, you can see that you have a very small chance of experiencing a loss. In fact, if you have a diversified portfolio, and this is data from 1950 to 2023, so this encompasses the pandemic, encompasses 2022, which was a bad year for both stocks and bonds. But if you have a 10-year horizon, on average, you're going to have a positive return and a meaningfully positive return. And so, if you look at, a 20-year horizon, which would certainly encompass most of our upwardly mobile kind of millennials at this point, then you really do have, a reason to be confident in your long-term prospects if you're diligent, if you're consistent, and you don't get emotional and do things that are often triggered by emotion, which often happens when you have, like, say, that 1 year focus that's over on the far left, which exhibits a lot more volatility. Again, there's a very strong power of long-term investing that's incumbent in these numbers here. And so I just offer, this as a prime exhibit to encourage you to remain steadfast over long-term investment horizons. Here we have a really busy chart, and you've seen, these charts from JP Morgan before, but I always love to sprinkle that back in, especially when we get updated data. And just to be clear that this one, just like the last chart, is updated through 2023, which again encompasses the 2022 bad year that we had. And you can see here that in any given year, you're apt to have a point in time where return for the S&P 500 is negative. And you can see that that's or like a drop of of a certain amount. You can see that in the red dots here. And so, most years is fairly benign. You get like an intra-year drop of, maybe 6 to 10 to 12%. And of course, at the time, it doesn't feel that great. But often when you have those drops, you wind up with a really good year anyway. And so this is another one of those touch points that is here to serve to remind you that even though we might have pockets of kind of intensified volatility, that more often than not, the averages are going to be positive by the end of the year. And you can see here in most of these years where you had an intra-year decline of some measure, that you oftentimes have a very significantly positive outcome by the end of the year. Another chart from JP Morgan is also very important. So again, speaking to pockets and moments of peak volatility, this represents the consumer sentiment index and subsequent 12-month S&P 500 returns. And so sentiment is usually, correlated to economic health, and there's a lot of other factors that go into that. But sentiment's generally bad when, the overall economic environment is poor. So you can see here in 1975, we had a trough in sentiment. 1980, May, October 90, and you can see scrolling over, obviously November 2008, and then 2011 again, and then June of 2022 was much more recent and painful for those who remember, that month ending movement in the stock and bond indices. However, the numbers that are posted next to these dates, where sentiment has troughed, represent the S&P 500 return over the subsequent 12 months. And so this speaks directly to contrarian investing. So when sentiment is at its worst point, that's the best time to invest. You get the most leverage for your return, right? And so when sentiment is high, that's not to say you won't have positive returns, but you are more apt to have negative returns after hitting interim peaks in sentiment. So the time to really make sure that you are invested, that you're in the market, is precisely the moment where some people, from a behavioral standpoint, might be otherwise inclined to want to raise cash and stay in cash, and that's time and time again, it's proven that the best time to be invested is when the market's at its worst point. We have some lessons in the power of compounding, and so the top half of the chart represents S&P 500 and reinvesting those dividends. And I've always said that the data shows us that over long periods of time, much longer than the 1993-94 that we see here, going back decades and decades, that we have seen about 40%, 45% of total return be generated from dividends, and those kind of metrics seem to play real well in this top chart here. You can see that if you reinvest dividends from using January 1st of 1994 as a starting point, that you would have generated from $10,000, you'd be at 208, almost 209,000. Now, if you had not taken those, reinvested those dividends and taken them out, then your return would have been about 118,000. So you can see the power of the income factor in equity investing. And then down below, you see broken down by different subclasses, if you will. So obviously you've got stocks, small and large, and you can see over a long period of time, small caps have outperformed large caps, and that's certainly not been the case here recently, but that is something that that we look at from an asset allocation standpoint, that small caps are actually very cheap right now. But there's a long-term power of those of stocks of any size in long-term returns. And then below that, you see corporate bonds in the blue line that outperform T-bills and inflation. And obviously, you want every investment that you have in your portfolio to be outpacing inflation. And you can see that T-bills roughly have matched inflation over a long period of time. So there is power in diversification, there is power in long-term investing, and there is absolutely power in compounded returns. This chart is from FS Investments, talks about kind of credit risk. And, these are things that, we've paid a lot more attention to with credit spreads being really, really tight right now. And, just very uncharacteristically tight right now. So the market, what does that mean? That just means that the market doesn't believe in any way, shape, or form that we're going to have an economic downturn. Because it's pricing credit to be fairly sound. If you felt like, we're on the cusp of some slowdown, then you'd see those credit spreads blow out and you'd see yields on high yield instruments be a lot higher than treasury bills. And that's simply not the case. We have something a little bit later that kind of shows that. But here we have looking at different areas of the credit markets, whether you got direct lending, those represents like private credit and some of the things that we've been talking about here as a firm that we're increasing our exposure to. And those loss rates are very low. And this data goes back to 2005, but relatively low. And you look at leveraged loans, really in the same ilk. And then high yield bonds, oddly enough, only have about a 1.5% loss rate over, essentially, call it almost 20 years worth of data, which in all three of those cases is much less than what we see in C&I bank loans that are made through the traditional banking channels. So a very interesting set of data right here. Slide here from Business Roundtable on CEO's view of the employment situation. We've talked a lot about employment and labor and the labor market lately, and how it's oddly been very resilient despite maybe some softening in certain areas and hiring intentions on small businesses being a lot more subdued. But we certainly see CEOs a lot more optimistic. In fact, you see this dotted line here. That represents this is a diffusion index. So anything below that dotted 50 line represents, CEOs that are, that believe that they're going to be decreasing employment, but that's not the case. That number's up near 60. Again, I generally say that anything above in a diffusion index above 60 represents a pretty strong environment. And obviously 21, 22 was a snapback from the pandemic, but overall CEOs are fairly optimistic now as far as like the labor market goes. These charts we have from S&P Global. This represents U.S. manufacturing PMI. Again, above 50, just like we saw on that last slide. Diffusion index, anything above 50 represents expansion. So we have moved out of that kind of that negative environment that we saw and kind of really that rolling recession that we saw within the manufacturing sector. And this seems to be more evidence that we seem to be pulling out of that right now. Slide on over to the right, you see new export orders being positive. So that's a good trend there. And we've recovered significantly from roughly a year ago in that category. Here we have input prices. So, we talk a lot about producer prices, and they were higher than expected in the latest reading, and that caused more turbulence in the market. And market was calmed a bit by consumer prices being lower than expected, but we see here input prices on manufacturing PMI moving higher. So again, a diffusion index here. So prices you would expect with a low rate of inflation to always be rising to some degree, but we do see a little bit of reacceleration here in input prices. And on the right-hand side, you can see here on manufacturing PMI, you've got in the black line, you actually have the PMI number, which we've already looked at, which we know is positive. And then we also have new orders to inventory, which is advanced about 3 months as kind of a leading indicator. And so, what that seems to indicate is that perhaps we are going to have some inflation still embedded in the manufacturing side for a bit longer. You have global services PMI, which is above 50 as well. So positive reading in manufacturing, even if input costs are a little bit higher, but services clearly still in expansion mode here in the US. Little update on rents as we have data from CoreLogic here. You can see here this is data broken out between single family attached rental residential units and single family detached rental residential units. And you can see here that we've seen actually a rather dramatic drop in rents for single family attached. And even if single family detached has taken a little bit of a leg up here, we see overall rents being negative. And I do think this is, again, one of those inputs into core inflation that is, I think, not often discussed, or not discussed often enough, probably is a better way to say it. And if this trend continues and the magnitude of this drop here in attached single family residential units, as those rents continue to drop, then it's going to have an impact on inflation overall. Interesting chart in the Wall Street Journal last week. So it's just talking about, lower birth rates and replacement rates for future labor markets, decades and generations down the road. And, it was kind of an article talking about, the strain of, having multiple generations under one roof and whatnot. And you can see here, this is just a kind of a sentiment index published in the Wall Street Journal that you see a decline as we, looking at pre-pandemic levels, certainly in all adults in that dark line there, and then the kind of that amber line, if you will, if you're just looking at parents, that, the sentiment of how they feel like they're doing financially seems to be going down as obviously there's more strain to maintain, total household spending and household well-being, especially when you have multiple generations under one roof. Alluded to this in an earlier slide, but we see credit spreads be very, very tight. So this is a yield premium. So if you bought a junk bond, and that's a bond that has a low credit rating, a bond that is much more likely to default than obviously a U.S. Treasury would. But you see the yield premium is only about 3% right now. So you buy a bond that has a much higher rate of or risk of default, and you're only getting 3 percentage points above a U.S. Treasury, which is still viewed as kind of the risk-free asset. It's a very interesting development. You can see the trend over time, and it's just it's unusually tight at the moment. We got a lot of data here. Don't often talk a lot about the commodity basket and the metals indices, but here on the left-hand side, you've got copper. This is data that goes back about a year, and you can see that right about February, beginning of March, we had a tremendous spike in copper. And that's a demand factor. It's a supply factor as well. There's some M&A. Mergers and acquisitions activity that's being discussed amongst the major copper producers, and obviously China is trying to exert some hegemony in the copper market. It wants to control a lot of these critical construction and industrial metals, and you can see copper's influence below that in the lower left-hand side on the overall industrial metals sub-index. And we've seen a tremendous spike in just a couple of months in that index. And if you travel over to the right-hand side, we've got Alpine macro data kind of broken out into several subcomponents. And we also include gold, which we know has been very, very high as of late. And you can see how in that red line represents the dollar index inverted. So as it is meandering down, that represents the fact that actually the dollar is strengthening over time, not weakening. And so that strengthening in turn is leading to higher overall commodity prices, as you can see here. Copper leading the way, but gold obviously is in that basket as well, and then industrial metals as well, and to a lesser extent oil. I want to talk about earnings, and we've already seen in the chart pack here that earnings estimates are meandering higher as we get towards the end of the year. These are the expectations for the S&P 500. And the good thing here, and I actually should have paired these consecutively, but that's all right. What we're seeing here is that the Magnificent Seven, which have exhibited strong earnings growth, which have helped to justify some of the outrageous multiples that they're trading at now. We do see deceleration in the Magnificent Seven earnings year over year as we trend towards the latter part of this year. But the good thing is that we see that other areas beginning to pick up, and we see a lot more a broader based economic or earnings recovery, I should say, than just the Magnificent Seven. So when you look at the fact that in that earlier slide that we have kind of an uptrend in earnings estimates, just know that that's being driven by a broader part of the market and not just those high-flying stocks. And that's a really good sign when we have greater breadth in the market. That's a really good sign for sustainability within the overall equity markets. Looking at small caps, we still have a conundrum here. Small caps are certainly cheaper than large caps, but this is one of the things that kind of compounds that whole argument, is that you've got essentially 41% of the companies in the Russell 2000 that still have negative earnings. And so it's a lot harder to put kind of a target multiple on an index that has so much representation by companies that don't have positive earnings. It does skew things a little bit, but there is still a very strong argument to be made for the rest of the small cap market and its contribution to overall investment performance over the next several years. On this chart, we have kind of a follow-up to the tight credit spreads that we saw a few charts ago. And, these are companies that are investment grade, but they have negative prospects. And so this is kind of like the secret within the silver lining here is that, even though, there's not a feeling that in terms of how we see the credit spreads, that there's not a feeling that there's imminent, problem in credit. We do see a lot of companies that are investment grade, but marginally investment grade with that are on negative credit watch, meaning that they could be downgraded to a point where they're no longer investment grade, but they're just slightly below investment grade. And so, we call these kind of fallen angels, so to speak. And so that number is actually picked up. So while we haven't seen a lot of actual downgrades, we've seen negative watch really pick up amongst that lowest tier of investment grade. And so, this frankly could present a fairly good investment opportunity in those fallen angels, which are really just from a credit standpoint, just one notch below, but they have historically been money good on their payments. I saw this data out of T.S. Lombard that really caught my eye. We talking about the global backdrop, talking about, European weakness and some of the other strength in emerging markets, ex-China. And this chart, if you really drill down, it's a little busy. It's got a lot of different categories here. But if you're looking at the global backdrop, and that thick green line that's trending up is indicative of what this trend really looks like. So you've got, and then even in that kind of that dark thin line there too, that represents companies, or countries rather, that are either in expansion or in recovery. And that number continues to skew upward. And so we do see this kind of, I won't go so far as to call it a coordinated global recovery, but there is a recovery, there is improvement in the economic backdrop on a global basis. So I referenced this chart a little earlier. So we've got number of S&P 500 companies that mentioned inflation in their earnings call has gone down. So this is over, looking over a 5-year horizon, and you can see how that obviously picked up during the peak of inflation, and it's consistently dropped ever since. And so we see that that trend continuing and likely to continue unless we get an unexpected bump in inflation. And, as a result, we see, more tempered expectations with regard to, what the Fed is going to do. Inflation's not a problem. People are still looking for the first rate cut, but since we've seen fairly strong economic data overall in a lot of the charts that I've even shown you today, the expectation is really gone down for rate cuts as well. So, if inflation's not as much of a worry, but the expectation of rate cuts is also really not as profound as it was, several months ago. And so here you got 43% of fund managers that expect the first rate cut to be in the third quarter of this year, and you've got about 40% that expect it to be in the fourth quarter. And interestingly enough, you got 14% that don't even think there's going to be a rate cut this year, and I'm almost in that camp. But I'm very pessimistic on getting a rate cut probably for the next several Fed meetings. And if we get one, maybe we get it towards the end of the year. So I'm probably more in that 39% camp. And then, just like every survey, you're going to have people that are really pretty entrenched in their theories, and they don't expect 2%, doesn't expect the Fed to cut rates in the next couple of years. Here we have a chart with basically estimates for the S&P by the end of the year. And so you can see here that this is on the right-hand side, it's a composite of basically all of the estimates from the major investment banks, starting with BMO, Capital Markets, now all the way down to JP Morgan. You can see that there's a pretty tight band, and just understand that the S&P 500 closed this last week at about 5,300, and so you can see that once you get down to like past Morgan Stanley and you get to RBC, that those estimates represent levels that are lower than where we are in the market right now at not quite mid-year. So again, the estimates, as they usually do, have a pretty wide range. On the left-hand side, you can see where this composite is in that blue line and where the actual S&P is in its current form. So we've obviously had a fairly strong May, kind of like ended well with some bumps along the way with the inflation reports that we've already talked about. But you can see it's the top half of the right-hand chart here, you're looking at maybe, at best, maybe a 8-9% overall gain by the end of the year. But these forecasts are just, it's so hard to forecast. And I do this with like an ounce of amusement because these estimates are often wrong. I think it's easier to try to predict the direction of the market than it is to predict a level on December 31. But I think the takeaway from this chart is that that I think we should not get carried away with our expectations, even with earnings picking up. I think what's happening here with we've got these price to earnings multiples that are expanding, but we also have the expectation of earnings increases throughout the end of the year. That really what that's doing is earnings are catching up to the multiple right now, and that we're not really going to have multiple expansion. In fact, if anything, we might have flat multiples through the end of the year, or maybe a little bit of contraction, which will set the stage for a good equity market, but just not the robust and crazy, equity markets that we've seen in the past. We're going to end here with a couple of a few charts on China. So interestingly enough, container ships coming out of China, we see those container rates moving higher once again after they've been sliding for several months. in view of kind of a weakening Chinese economy overall. So this is a very interesting development. Obviously, an input cost to shippers that we want to monitor. And then we've got a share of key battery metals, which are controlled by China. And you can see that, the majority of some of these very critical components, are controlled by China itself, in China, or they're controlled by companies that are majority owned by the Chinese, either the Chinese government or proxies of the government here. And so this is an article from the Wall Street Journal just talking about key dependencies related to China. And then the goods deficit with China as we work to diversify our trading partners away from China. We see trade deficits falling rather dramatically over the last year. We actually talked this time last year about how, despite all the tariffs and all the trade rhetoric, that we actually had a multi-year increase in deficits with China, and trading with China actually picked up. Well, that's clearly in reverse right now, and it'll be very interesting to see where it goes over the next couple of years. That's all we have for this week. Again, hope you have a wonderful Memorial Day weekend, and we look forward to talking to you again very soon. Take care.